Hey guys, and welcome back to another episode of the Dividend Portfolio Weekly Update. As of today, September 29th, the portfolio is sitting at a valuation of $29,931. This is down a little bit since the last time I had one of these portfolio updates. We've kind of seen some market volatility caused from a number of issues, but mostly concerning what we've seen going on in China, as well as the rising inflation concerns we've seen at home. We've kind of stemmed off inflation for at least the past few months, but there is, again, some jitters on Wall Street that the inflation is really starting to get going, and it will only get worse from here on out as we approach the holiday season. So it's kind of, again, caused some concern on Wall Street, and we've seen a little bit of a broad market sell-off. In fact, if we check out the Dow Jones, it's down about 2.7% over last month, down almost 1,000 points. The S&P is a little bit worse off, down about 3.5%. And then the NASDAQ has been hit the hardest because usually concerns about inflation or rising interest rates usually hit the tech sectors the hardest. The NASDAQ is down almost 4.7% over the last month. So again, during this market sell-off, I've been kind of proactive in trying to buy some more defensive names as well as companies that I think are a little bit undervalued or at least have low valuations. So if we go to my activity here, my most aggressive buy took place on September 24th, where I bought FedEx, Johnson & Johnson, and Coca-Cola. FedEx has been hit particularly hard over the last month for a number of reasons, mostly because they did lower their forecast for the next year in terms of their revenue and profitability. So this kind of spooked investors, and they've shaved off about 15% over last month, I do believe. Johnson & Johnson's another company that I think has a pretty low evaluation for where they are as a company. And then Coca-Cola is a nice, safe, defensive player, especially to hedge against some of this market volatility. So just to talk about these three companies a little bit more, first, again, I'll talk about FedEx. FedEx is currently trading at $221 with a forward PE ratio of 11.19. This is exceedingly cheap for a good quality company that's been growing their dividend over the last several years. That's another positive of earning FedEx's stock. Again, over the last month or so, we're down about almost 17% actually. Here on the 21st, 22nd of September, we saw a significant drop when they did lower their year-over-year projections. But I still think FedEx is a good buy, especially at these levels, even though it has actually continued to trade down even since then. I think FedEx is probably a case of a company that's going to be impacted by these supply chain shortages. But I think if you're a long-term investor that have many, many years ahead of you, I think FedEx is at a good entry point. Another safe defensive quality company that I'm also buying more aggressively recently is actually Johnson & Johnson. This is a company that I not only hold in my long-term portfolio, but it also is in my Roth IRA. Johnson & Johnson for the last couple of months really has kind of peaked at about $179, but has since traded downward all the way down to about $164. They have a forward PE ratio of about 16.88, which is still a little bit richly valued, especially if you compare it against Pfizer and AbbVie. But I actually think among the three of them, Johnson & Johnson is the best company from top to bottom. Plus, at the current prices, you're getting a forward dividend yield of about 2.6%, which also is a nice boost. Johnson & Johnson is a high-quality company that has a diverse business interest from the medical field to offering consumer products. So I think if you're looking for a good, well-rounded company in the healthcare sector, I can't think of a better company than Johnson & Johnson to own. And then lastly, probably the most defensive stock of the three is Coca-Cola. Coke is obviously a huge staple of Warren Buffett. He's owned a ton of it for decades, and it's pretty easy to see why. Coca-Cola is a very probably boring company, but it is a very safe investment that really isn't going to move too much up or down, especially with market volatility, but has had nice returns over the last several years. And on top of it, you get a 3.2% dividend yield at current prices, which if you are a dividend-oriented investor or if you're an older investor, I think Coca-Cola is a high quality company to consider owning. I own it in my long-term portfolio, and that is why I've been buying more recently. So on top of my buying the dip, my bi-weekly deposit also went through on Monday, where I decided to make 3 more purchases. I decided to buy JP Morgan, which is another company that I think is actually a little bit undervalued at probably current prices, since we did see a pretty hard sell-off in the financial sector after the news about what's going on with the debt crisis in China. But I also put the other half of the funds into my consumer staples pie, where I let auto invest almost $42 into Coca-Cola and about $13 into Target. So I decided to let that auto invest because I am a little bit underweighted in my consumer staples pie. Tried to get it beefed up a little bit. On top of this, though, I did want to talk a little bit about M1 Finance's new feature, where they want to break down the dividends you're earning by pie and by company. So this is a little bit of a dividend tracker that they're integrating into the program, which I think is a much needed and much appreciated feature to kind of keep track of exactly which companies are paying you and how much they paid you over the course of you owning them. Now, my pies aren't exactly accurate. Since a couple months ago, I did really shake up how I have my pies laid out and formatted, so that information wasn't exactly carried over from one company to another whenever I moved pies. But since I've been on M1 Finance, I've earned $786.39 in earned dividends, which is pretty cool. So continuing on talking about some dividends, I've actually been paid out over the last couple of weeks since I made my last update. I'll go over to my activity. We've actually earned dividends from Realty Income, Waste Management, and Bank of America. This kind of is getting it to the close of September, which has been a really, really good month for earned dividends, which we can go over here to my Google Sheets where I keep track of all this stuff. I've actually almost crossed over the $100 mark between my long-term and Roth IRA portfolios. This has been really, really good. It's actually been one of my best months ever. Had I not sold off some of my higher yielding positions over the summer, this actually probably would have been by far my biggest month for dividends. But I have cut down my yield a little bit and to get into positions that pay a little bit more of a dividend growth mindset rather than just current yield. So I have sacrificed a little bit of current payout for future payout, which I think is fine considering I have, decades long time horizon. But yeah, in my long-term portfolio, we've had quite a month. We've had all of these companies pay out about $82.77 in my long-term portfolio. And in my Roth IRA, we're sitting at about $17.02, which is nice to see those dividends really roll in, especially since October is going to be a pretty slow month. Usually the months following the March, June, September, and December months are usually the worst for dividend payers. So I wouldn't expect too many dividends to roll in October. But of course, we'll take anything we can get to really get that snowball continuing, since we are reinvesting all of our dividends. As far as other activity I have going on, I haven't really decided what I'm going to be buying next, but I've toyed around with the idea of maybe buying the dip again if we see another broad market sell-off. The markets are up today, so today won't be that day, but maybe here, if something else does happen, I could see buying a little bit more in my industrials and consumer staples pie. Maybe some more Raytheon, or potentially some more Target, maybe even Procter & Gamble, depending on what happens. But I'm also keeping an eye on my technology pie, since I've actually become undervalued in that pie, since we've seen a sell-off in the tech space, especially concerning inflation and rising interest rates. So that is another thing to consider. I could be looking to buy more Apple and Microsoft specifically. IBM probably won't be anything I'll be buying anytime soon. I've kind of lost favor a little bit with IBM, but it's still a position I intend to hold. But definitely Apple and Microsoft are under serious consideration to buy a little bit on this dip. So that's probably going to pretty well wrap things up for this video. If you did enjoy it, go ahead and drop a like, as well as leave a comment, your thoughts on what you're buying during the market dip, and kind of let me know what you're buying and why you're buying it. So that's going to do it, and I will catch you guys on Monday.